The U.S. economy, once a picture of robust growth, is showing unmistakable signs of slowing down. Over the past few years, we have witnessed a period of unprecedented expansion, with businesses thriving and consumer confidence soaring. However, recent data suggests that this era of prosperity may be coming to an end. The once bustling streets and thriving financial districts are now giving way to quieter neighborhoods, signaling a shift in economic momentum. Like a ship encountering choppy waters, the economy is being buffeted by a confluence of factors that are raising concerns about a potential downturn. Global trade tensions, fluctuating commodity prices, and geopolitical uncertainties are all contributing to this economic turbulence. The storm clouds are gathering, and the once steady ship of the U.S. economy is now navigating through increasingly rough seas. Key economic indicators, those vital signs we monitor to assess the nation's economic health, are painting a worrisome picture. The stock market, often seen as a barometer of economic sentiment, is showing signs of distress. Financial analysts are closely monitoring these trends, and the headlines are filled with news of economic slowdown. The data is clear. The economy is facing significant headwinds. From a weakening job market to declining consumer spending, the evidence is mounting that the economic engine is losing steam. Unemployment lines are growing longer, and shopping malls, once bustling with activity, are now eerily quiet. Storefronts display "For Lease" signs, a stark reminder of the challenges facing small businesses. Consumers, the lifeblood of the economy, are tightening their belts, leading to a ripple effect across various sectors. Businesses are grappling with rising inventories, a sign that consumers are pulling back. Warehouses are filled with unsold goods, and retail shelves remain fully stocked, yet customers are few and far between. Business owners are feeling the pinch as they struggle to move their products and maintain profitability. The once vibrant marketplace is now a landscape of uncertainty and caution. Credit conditions are tightening, making it more difficult for businesses to invest and expand. Banks are becoming more cautious, and loan rejections are on the rise. This tightening of credit is stifling growth and innovation, as businesses find it increasingly challenging to secure the funding they need. The empty boardrooms and closed signs on small business doors are a testament to the struggles faced by entrepreneurs in this tough economic climate. The manufacturing sector, a bellwether for the broader economy, is contracting. Factories that once hummed with activity are now eerily silent, with machinery standing idle and production lines halted. Workers, the backbone of the manufacturing industry, are facing layoffs and reduced hours. The dejected faces of those leaving the factory at the end of their shift tell a story of economic hardship and uncertainty. These are not mere blips on the radar, they are flashing red lights that demand our attention. The warning signs are clear, and the data is alarming. Financial analysts are sounding the alarm, pointing to the need for immediate action to address these economic challenges. The road ahead is uncertain, and it is crucial that we remain vigilant and proactive in navigating these turbulent times. The future of the U.S. economy depends on our ability to respond to these warning signs and steer the ship back to calmer waters.
The job market, a crucial pillar of a healthy economy, is showing signs of weakness. Recent data indicates a troubling trend that could have far-reaching implications for both businesses and workers alike. After months of robust job growth, the pace of hiring has slowed considerably. Companies are becoming more cautious, and the number of job openings has decreased. This slowdown is causing concern among job seekers and employers. The unemployment rate, while still relatively low, has ticked upward in recent months. This increase, though slight, is a signal that the job market is not as strong as it once was. Many individuals are finding it harder to secure employment. Particularly concerning is the slowdown in high-growth sectors like technology and finance, which are often seen as leading indicators of economic health. These sectors have been the backbone of recent economic expansion, and their struggles could foreshadow broader economic challenges. The ripple effects of these slowdowns are being felt across various industries, leading to a more cautious outlook for the future.
Consumer spending, which accounts for roughly 70% of U.S. economic activity, is losing momentum. Inflation, while moderating, continues to erode purchasing power, forcing consumers to make tough choices. Rising interest rates are making it more expensive to borrow money, further dampening consumer spending. The housing market, a key driver of economic growth, has cooled significantly as mortgage rates have surged.
Businesses are grappling with a growing problem: rising inventories. Across a range of industries, from automobiles to apparel, unsold goods are piling up on shelves and in warehouses. This buildup of inventory is a telltale sign that consumer demand is weakening. Businesses, faced with excess inventory, are likely to cut back on production, which could have ripple effects throughout the economy.
The availability of credit, the lifeblood of the economy, is tightening. Banks, concerned about a potential economic downturn, are becoming more cautious about lending money. Lending standards are being tightened, making it more difficult for businesses to secure loans for expansion or to cover operating expenses. This credit crunch, if it continues, could further dampen economic activity.
The manufacturing sector, a key barometer of economic health, is contracting. Manufacturing activity, as measured by the Institute for Supply Management's Manufacturing Index, has been in decline for several months. New orders for manufactured goods are falling, indicating that businesses are growing more cautious about the future. A prolonged contraction in the manufacturing sector could have far-reaching implications for the broader economy.
The road ahead for the U.S. economy appears increasingly bumpy. The confluence of factors we've discussed, a weakening job market, declining consumer spending, rising business inventories, tightening credit conditions, and falling manufacturing activity, suggests that a slowdown is underway. While it's too early to say with certainty whether the economy will slip into a recession, the risks are clearly elevated. In these uncertain economic times, it's prudent for both individuals and businesses to prepare for a potential downturn. The economic landscape is shifting rapidly, and being proactive can make a significant difference in weathering the storm. Individuals should focus on shoring up their emergency funds, paying down high-interest debt, and creating a budget that prioritizes essential expenses. Building a financial cushion can provide peace of mind and stability during turbulent times. Being mindful of their spending is crucial. Adopting a minimalist lifestyle and cutting back on non-essential purchases can help stretch your dollars further. Every little bit saved can add up over time. Businesses should carefully manage their inventories, conserve cash, and streamline operations to reduce costs. It's important to stay agile and adapt to changing market conditions. Avoid taking on unnecessary risk by conducting thorough risk assessments and making informed decisions. Collaborating with financial advisors can provide valuable insights and strategies. By taking these steps, we can navigate the challenges ahead and emerge stronger on the other side. Together, we can build a resilient future ready to face whatever comes our way.